The following is a presentation of TFNN. Now, TFNN opens the door to the future. Larry Pesavento, systems analyst, is your tour guide into the market futures. Want to see into the future? Well, climb aboard Larry's time machine and come with us. Larry takes your phone calls now, toll free at 1-877-927-6648. This is the Futures Hour. Here's your host, Larry Pesavento.
Okay, good afternoon, folks. This is Larry Pesavento for TFNN. Finally back at the helm here after a couple of weeks of fighting the allergies. I was attacked by 2 Palo Verde trees out here, and boy, they really whacked me pretty hard, but I'm on the mend, and I'm gradually getting a little better. We've got a lot of things to cover today. The main thing is that I wanted to let you know that, as most of you know, that we've been in a downtrend here most of May when we talked about the sell in May and go away. It's following the Bradley model pretty well, and if you'll notice it when you go into Tiger TV, it's pretty much of a downtrend into early July. And so, you want to keep in mind here that any rally here is probably going to be short-lived, and we are certainly oversold right now. We are down, I think, 7 days in the Dow, and I think maybe even longer than that in the NASDAQ. And so we want to keep an eye on any type of a rally here if we get one, and we should, because the market is oversold, and it does have these, really vicious rallies where it moves, quite a bit in one direction and in just a few days. We've got a major day coming in on the 15th of May, which is next Tuesday. That has related to the planet Venus. It has a lot of things that are occurring geometrically, with the planet Venus that should, mean something, dramatic in the stock market. But, we'll have to wait and see if it does unfold the way we think it is. The ideal situation, if you're bearish, is you'd see, the market rally today, tomorrow, Monday, and then make a higher high on Tuesday and then start down. That would be the ideal situation from a bearish scenario, and that's what we're going to keep an eye on. Now, the next thing I want to cover before we get into the commodities hour, and this is part of the commodities, is the Treasury bond market. We have, gone up and tested the 786 3 days in a row this week. We have gone above it just a little bit. We're trading right at the 786 retracement off of the December high right now. We haven't gone above it as of yet, but we are getting very, very close to that spot. So we want to, watch that, because we've been up for, almost 6 weeks straight up in bonds without much of a correction. And any correction, in my opinion, you want to be looking to be a buyer. Now, that's the long-term bond. Now, on the short-term, on the Treasury notes, which are the 5 to 20 year or 5 to 10 year, those have already made new contract highs. They've gone up and they've completed, the larger AB equals CD pattern. That would be equal to the one that we were looking at in the Treasury bonds up in the 149 to 150 level. So the notes have already completed it. And now we're waiting to see what this correction is going to give us, because we have decidedly gone into new high territory. We're still trading quite above it, and so the $64 question is are the 30-year bonds going to be able to make that 149 level? And I think it all depends on what happens in the stock market, and if there's going to be another flight to quality. The long-term chart that we've been watching on this going back to 1981, says it should end up around the 150 level. Tom thinks it might make 160, which it certainly could, given the craziness that we have in the world today. And so we'll have to, just to see if the market is going to, sell off, the stock markets of the world are going to sell off, then we'll have to understand if the market will have this, last burst of flight to quality. Because I think that is the best trade that we could be looking at for the next 4 or 5 years, maybe the next decade. I think the analogy would be is, people buying Treasury bonds as a flight to quality is like a fireman going into a blazing building carrying a gasoline can with the hopes of taking the fire out. So this is one of the things that we have to watch, because if we do miss it, and we thought we missed it a couple times, but we were patient and we got back to that level, and we were still able to get to our price level. And so we want to still be patient. We've still got a chance to get up to this level, and much of it depends on what I think is happening in the rest of the world. As far as, everybody's watching Europe, of course. And, folks, this is not new. We've been talking about this for months on these shows, the fact that we've had lower highs in all of the markets. We looked at the FTSE, the French market, the German market, all of those, and all the Asian markets, all of them had been turning down. They all were in downtrends. It was only the U.S. market that was able to go up and make new highs, and it did it pretty close to what the Bradley thought it was going to do, and it went a little above it as far as the NASDAQ exceeded the 1.618, but the New York Stock Exchange Index never violated the 786 at any time, and that's the one that I watch because it's the broadest market indicator of all. So that's what we're keeping an eye on, and we have the the TBT, which is supposedly it is not supposedly, it is our trade of the year, and we're trying to buy that down at the 1675 level, and we got down to the 1775 level yesterday. We're having a rally today because the bonds are selling off, but we still have a really good chance of getting it down to that level. And so we just want to be patient, and we'll see if we can eventually get to that spot, and that's what we're really trying to accomplish when we're watching these things, is to get in at the best possible time that we can possibly come up with as far as entry point. That's the main thing that we are trying to accomplish. So if there's something that I would like to talk about that I think is very important, because we have a situation coming up with an IPO, and it's basically the IPO for Facebook, and it's going to be a big thing, folks. I mean, everybody's talking about it. It's probably going to be oversubscribed. Now, what I want to do now is I want to take you back historically, because these markets have a tendency to repeat themselves in many different ways, and we have one set up now that is very interesting, because we have the Facebook IPO coming out for Facebook, and everybody is, it's going to be certainly be oversubscribed. And all I want to do is take you back historically to July of 2008. And July of 2007. And what was happening at that time is Blackstone, which is the largest private equity group. They have, I think, $4 trillion, and they were coming out with their initial public offering, and they were offering their stock for the first time. It had all been private, and everybody wanted to buy this stock. And I was called on as a consultant to a hedge fund that wanted to put a very large investment into Blackstone, and I was strongly against it because I was very bearish in 2007, and I said, why are these people, the smartest people on Wall Street, after all these years, finally going to let you in? I said, this doesn't make any sense to me. And I said, if nothing else, I said, wait a few days just to see how the market responds to the IPO and see what happens. And if you go into Tiger TV, you'll take a look at what happened, with the Blackstone IPO. It came out oversubscribed at 38, and it went all the way down to under $4 a share in the next year and a half, and has now rallied back to about 14. So it's still far, far underwater. So they're giving you a chance to buy this, but the question is why, and that was basically the answer of what happened. They did not listen to me and put a very large investment into the market. They bought it at around 32, as I recall, and I don't know where they did get out of it. So anyway, that's just the way it looks. You want to keep a memory bank in here, because markets have a tendency to repeat over and over again, and this is going to be an IPO that everybody is watching. Much like they did with Google. But I don't know. I don't think Facebook is the same as Google. I don't understand these tech stocks anyway. But with Google, it had so much information, whereas Facebook is social media, and I'm sure it's a great thing. It's going to be wonderful wonderful, 20 years down the road, but whether it's going to be priced at the right amount or not, I don't know. My opinion is do the same thing with Facebook that you're going to do with the Blackstone, is wait a few days just to see how the market takes it, because if the market doesn't, like it and it sells off, that's telling you something right now, that they either overpriced it or the expectations are a little too high. So, that's something that you want to keep in mind. Because I think it's going to be a market indicator of what the market wants to do. In other words, how strong, will our rally be in the stock market, and are we going to be able to see if that is going to be, the spot where, it's going to be a good place to buy, Facebook. It's going to be interesting no matter what. I don't think that, think there's any question, about that. Now, the next thing that I want to cover, and this is, I think, probably the most important thing that I'm looking at, for this week, and that is the fact that we have had a major test in gold and silver. We've been talking about that 1580 level, and we hit it 1578 yesterday. We rallied about $20, about $30 an ounce off of that low, and we stopped exactly at that level in the gold market. And that in itself is very, very important. And then if you take a look at the silver market, we did exactly the same thing in the silver market. We stopped at the exact penny on the 786 retracement in silver. That's the one we were talking about, way back in April before I got sick and I left for a couple of weeks. We were waiting for that number. We did get down there. We hit it yesterday. We've rallied about 50, 60 cents an ounce off of that, which isn't very much. But the important thing is, if we happen to break below 1580 an ounce in the gold on a closing basis, and we break below 2860 on a closing basis in the silver, I would assume that this thing has broken and we are heading down big time. Remember in 2007 that the commodities, they soon, right after the stock market topped, the commodity market started down, and they started down in a big way. And so this is, we've hit major support in this in the gold and silver market. And if we take a look at what happened with the gold and the silver mining index, and that's one that I look at. That's the GDX. And if we take a look at this, you'll see that it stopped exactly at the 50% retracement off the November lows of 2010, and it did it with a perfect AB equals CD correction. And so as long as this gold silver index, or the GDX, the gold mining index, can stay above 41, and it's trading at 42.80 right now, it has made a pretty substantial bottom, in my opinion. So this is the line in the sand as far as a pattern recognition, watching the ratios of the Fibonacci sequence, that the gold and silver, we have drawn the line in the sand, folks. Anyway, take a little break here. 877-927-6648 if you have any calls.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of The Money Game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and The Money Game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about The Money Game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
X-Story Gold Mines, an NYSE Amex-listed company trading under the symbol XG, is slated to be the newest gold-silver producer in Argentina. X-Story is forecast to produce more than $250 million in bullion annually, beginning in 2013, at a cash cost of less than $200 for each ounce of gold produced. That forecast will make X-Story one of the highest margin operators in South America and a sector leader in the mining industry. X-Story has $50 million in its treasury, having spent over $60 million to date on drilling and engineering. The ultimate size of its Argentina discovery could be determined by year-end as results from the 6 drills operating at the site are fully assessed. To find out more about X-Story Gold Mines and their exciting growth potential, click on their banner on the front page of TFNN.com or check them out on the NYSE Amex under the symbol XG.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, folks, we're back. 877-927-6648, and we were on the gold and silver. And I repeat that the 1580 per ounce in gold is etched in stone. You don't want to go below that because it's a tombstone. It's a grave marker if you go below that, in my opinion. And that number in silver is 2860 per ounce. So keep a close eye on that. Now, on the gold mining stocks that we're talking about, the GDX that I posted into Tiger TV, I also wanted to put in one of the larger gold mining stocks, and that's Newmont Mining. And we have just made a major pattern in the Newmont Mining. We had a 3-drive to a bottom pattern coming in at the same time that we hit that number in the gold. And it's it's a perfectly symmetrical one done over a month. If you'll take a look at that, you'll see that it is just as perfect as it possibly can be. And that means that Newmont should not go below $43 a share. We're trading at 46 and change, as we're talking here. So these numbers are very, very important. If they violate them on the downside, that's just like if they violate them on the upside, they will go a great deal higher. So that's what I see in the metals. And I wanted to bring up the copper chart because copper has actually held up relatively well, compared to the rest of the metals. And, we have just barely made a 786 retracement the other day at the 362 level. We're only a little bit higher than that. But, copper has held up a little bit. and that might be indicative that maybe we are going to get a little bit of a rally in the stock market. But that's just a really far out stretch. I mean, there's not something that you can actually trade off of. I'm just saying the fact that copper has held up during this sell-off in the stock market relatively well. It got very little margin call selling like we got in the gold and silver, and then also in the crude oil, because those are the ones that the people are watching the closely. And since we began to talk about the crude oil, here again we have another market that's doing the same thing that we're looking at for a long-term basis here in crude oil and also in the gasoline. And what I'd like to do is to put into the Tiger TV. I'll start out with the gasoline futures because it's made some major things since the last time that we were on the air, when we had the bearish butterfly that was forming back on March the 26th. And since that time, the gasoline futures have sold off more than 11% over the last 5 weeks, and we've come into some major support here at the 50% retracement in the gasoline futures. And so it's important that we've had a small 3-day rally here, much like we're having in crude oil. And so it's here again, it's the importance of these lows that we're making this week. These lows that we're making this week in almost everything. I'm talking about crude oil, gasoline, and all of the things related to the gold market and silver market, gold, silver stocks. All of those have made a very, very important bottoms, and if they fail, that is not a very good sign for those metals and also the rest of the stock market. So just keep in mind that something really significant has happened here, and we want to be able to take a look at it. Now, in last week's letter, I focused on the Gartley pattern that was forming in the crude oil that was occurring up at that $1.06 a barrel. And the main thing that's happened since that time is we had one of the largest sell-offs that we've had since well over a year and a half. When we dropped 10% in the price of crude oil in a matter of a few days, that's telling you that the supply has overcome the demand, and the market has moved down. Now we're down 6 days in a row. We're up slightly today. We matched the same low at $95 a barrel 3 days in a row. So if you see crude oil start trading below $95 a barrel, that's going to be a very negative sign, because Tom on his show yesterday talked about the crude oil going to 81, and it could very easily go to 81, folks. That would just be a 61% retracement off of the lows from last October. So this is really important to 95. We talked about the importance of the 101 a few weeks ago, because that's where the market bounced off of. We made a Gartley sell pattern right after that had formed up at the 106 level, and now we have broken down, and we've broken down hard. I mean, they didn't bring this down easy. They didn't take any prisoners. 877-927-6648.
You've heard Tom O'Brien on the air, and you've always thought about trying out his newsletter, Market Insights. Well, now is the perfect time. For a limited time only, when you sign up for a 2-week free trial to Market Insights, we'll send you a free copy of Tom O'Brien's best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System. If you decide to cancel within the 2-week trial period, pay absolutely nothing and keep Tom's book as a free gift from us. Tom sends out his daily newsletter each morning by 9:30 a.m. with trade recommendations, including price targets and price stops. As recently as March 21st, Market Insights subscribers closed out a position for more than a 25% profit in just over 2 weeks. To get your 2-week free trial to Market Insights, along with your free copy of The Art of Timing the Trade, Your Ultimate Trading Mastery System, visit the front page of TFNN.com. Supplies are limited for this one-of-a-kind special, so act today and don't let this opportunity pass you by. Offer only valid for new subscribers. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks. 877-927-6648. And I had a request to put in the Tiger TV the SLV, which is the ETF for silver. And, it shows a beautiful harmony in the market. And, the fact that the SLV stopped exactly at the same price where the silver stopped. And so, yesterday's low in the SLV is your get-out-of-town spot, or, use your get-out-of-jail-free card, because if it goes below that, you don't want it, because everything is set up. I mean, it's set up as good as it can get, and if it doesn't work, it doesn't work. So we've got a call from Ray in Washington. Are you there, Ray?
I am. Good morning. It's sure good to have you back.
Yeah, finally. Yeah, it's good to be back. I actually missed it quite a bit.
Hey, I'll tell you what, the next time those trees start budding out, snip them off. Snip off the buds.
I think I'll get out of town. That's what I'll do.
There you go. Yeah, I wanted to have you take another quick look at the Bradley model. The one I'm showing, I got the DVD of it and posted it up and that kind of thing. And it looks like we need to scoot this thing over a month. I'm showing the low part of the Bradley model mid-June rather than mid-July. So I think the other day you were saying that you kind of expected things to, go to the downside from May to July, and then get a 1-month rally. and then sell off, I assume, in August again.
Yes, that's correct. I show my low coming in the first week of July, around the 7th to the 9th is what I'm looking at on the Bradley date. Now, as we get closer, we have a pretty good idea of where we are. But, we're in a pretty strong downtrend between, May 2nd and all the way into, the first week of June. So I'm expecting if we do get a rally here, it's going to be short-lived, and we're eventually going to take out that 12,700 in the Dow. And, because there's so much complacency in the market, Ray, you could get a big downdraft. We haven't had a big downdraft in a long time where we've had a Dow. We had some 400-point moves, months ago, but, we haven't had anything like that. It's been very, very quiet. And so I'm expecting a great deal of volatility during these next few months.
Okay. So you're saying that we should get the downdraft into mid-July then?
Yes, mid-July, around the 7th of July is what I show, and then we have an area where it goes a rally. Now, remember, it can be off by several weeks sometimes, but so far, it's been following perfectly. We had the bottom form in April, and it showed that the model was going to be up for about 3 weeks, and it was exactly up for 3 weeks into the 1st of May, just like we were last year, when we topped when bin Laden was killed on May the 2nd. And so, it's following. So my assumption is we got to watch to see what this rally brings if we get one here in the stock market, and I think we will, because we made a big ABCD to the downside in the S&P, and we also did that in the NASDAQ and also in the Dow, and so we should get a bounce just off of the ABCD.
I see. Okay. Also on the chart that I'm showing, the Bradley model, they have middle terms.
I don't know what that is. I keep my Bradley model as simple as possible. I use it almost exactly as Donald Bradley described it, because all I'm looking at are the energy points of either positive or negative spots of, whether these cycles are supposed to be positive or negative, and it's done better than any economist, that I've ever met in my 50 years in the business, and I've looked at 120-some years of the Bradley, and it's been very, very good. It's not perfect, but it's very, very good. And the other thing is, when it's working, you don't want to fade it. And right now, it looks like it's working.
Okay, yeah, I'm very impressed with it. I had no idea about it until watching your show. So I appreciate it.
I can remember my teacher, Dr. Miller, banging my head on the desk and say, "Take a look at this. It's been around forever, but nobody watches it." And so I was the one that sort of made it popular, and I'm glad I did, because it's helped some people. So thanks for calling in, Ray. I appreciate it.
Hey, thank you for your time, and, trim that tree.
Okay, I'll do my best to get out of town next time.
All right.
Okay.
Thanks a lot.
You bet. Okay, we've got a call from Mike in Florida. Are you there, Mike?
Yes, I am. The previous caller pretty much touched on a lot of what I was going to talk to you about, but I know Tom has a projection on the S&P to get back down to 825, and relating it to the Bradley model, with our major turn date on March the 16th, and then, we had the other dates in the model, the middle of April 23rd, relating to the bounce that we had. Mm-hmm. And now, it looks like we're heading back down in, and it looks like the next major turn, according to the model that I pulled up, is around June the 12th.
That's very close. Yes, that's right. It's the second week of June, and then you get about a 2-week rally. Right. Into the end of the June, and then you're down into July, and then in July you start to get a move. But don't go making any forward projections on where you think it's going to be, because exactly. Sometimes it'll shift. Let the pattern sort of help you. What I'm seeing now is the fact that we've had a big downdraft. We're down 7 days in the Dow, 7 days in the S&P, and that itself makes it an outlier event. So if we get a 3-day rally into the 15th of May, that's the one that I'm looking at, because there's some things that are happening. We have a P-index date on the 18th, which is Friday, but next week should be some type of a cycle high week in stocks. So that's what I'm watching, is to see how much of a rally we get.
Right, and then set up our next leg down and do it AB equals CD.
Yes, and Kate mentioned on her program, because of what's happening, across the world, not just in Europe, but also, in Asia and other places, like, Iraq and Iran with the nuclear stuff and, all the other baloney that goes on in the world. Any morning you could come in and there could be a game-changing thing that occurs, like, Greece pulls out or France pulls out of the euro or Italy pulls out. There's 3 countries there that could, pull out at any time. And if that does, I mean, if the euro starts to shake, and believe me, things are not good in Europe. All you have to do is look at the foreign stock markets over there, and they look horrible. I mean, Greece looks like it's in a major depression, and Spain already is. So, it's really, it's not good over there.
Right. Okay.
Okay, thanks for calling in, Mike. And as we get closer to these dates, we'll have more information, and I like to feature them on the show, so we'll be able to keep an eye on those.
Okay. And one other question, too, Larry.
Sure.
Okay, let's look at the date of June 12th, okay? It's showing up as kind of a strong date on my Bradley model. But in the past, is it possible that, let's say that doesn't turn out to be a turn date, but let's say, could that be a date where, let's say, there's possibly an acceleration into the trend?
Absolutely, yes, because that's what they do, is they do have spots where they're important because of the energy. That's what I've seen in the research that I've done. And all you can do is try to get close. That's the best thing you try to do, and you do that with taking the dates along with the pattern recognition and also a little common sense of where you think the markets are going to go.
Right.
And so if you do get an area where it's going to accelerate, it'll only be like a huge outside day, with a wide-ranging bar that something dramatic happened on that day.
Right.
And you just don't know what it could be. It could be a political event. It could be a geopolitical event. Like somebody getting a major earthquake or something to affect the economy of Japan or the United States or whatever. You just don't know. But when you see that, you just know that it could be an acceleration.
Right. Not necessarily a turn as it normally usually is, but it could be an acceleration in the same direction of the trend.
Yeah, the main thing that you'll have to watch is that if we are in a rally mode coming into the date, that'll tell you usually that it's a high. If you're coming down, it will usually be a low. And we've been following pretty nicely, since April. And so we're into the 5 weeks of the thing working, and so we'll see how it acts when we get into June.
Okay, great. Thanks. Glad to have you back.
Thanks for calling in, Mike. I appreciate it. Now we need to talk about the U.S. dollar here because I wanted to expand on what Tom O'Brien talked about yesterday, along with Steve Rhodes, and he talked about the gold and the dollar and how they related. And they are certainly related because the dollar index is directly related to gold in an inverse way. In other words, when gold is going down, usually the dollar index is going up. And what I've done into Tiger TV is I've posted the inverse price of gold over the dollar index, and you'll see that it has a very high correlation. In other words, when gold is dropping, the dollar index is going higher. Now, if we're correct that this is a major bottom in gold, then what we could be looking at is a possible, topping action here in the dollar index. Because what we're doing now is we're going back and we're testing that 80-50 level, which is the 786 retracement of the last swing that we had, back in on April. April the 2nd. So it's important to watch this because the dollar index really has to keep going, and if that means that, then that means that the gold is going to continue to go down because the correlation, if you look at this over the past year, has been incredibly strong. In other words, when the price of gold goes down, the dollar index goes up. And that's what Tom was talking about yesterday. It's the movement of money. And, people have to have dollars to buy treasury bonds or whatever the other things that they buy, and that's the economics behind it, I can imagine. But that's what we're watching when we're looking at this dollar index. It's held incredibly well. Now, on the other side of that, and I need to spend time with the commodities because these currencies are so important, with the with the ratios that we're dealing with here and the patterns, because we're looking at the euro, which is pretty much 53% of the dollar index, and we have gone and we're trading below the 61% retracement right now. And the importance of that is that the euro needs to get above 129.50, and that's what you're trying to do. We're down 8 or 9 days in a row now in the euro, so it also is oversold. It's made a big ABCD correction from the late February high, and so we want to be able to see if this is going to get a little bit of a rally here in the euro, and we'll have to wait and see. And this is a major thing that we'll have to be watching. But the dollar index needs to get above 80.50, to continue this trend up. We're trading around 80.20 now. The euro is trading at 129.55, so it's in that same ballpark of what we're watching. So the quality of this rally that we're going to get in the euro, and then also with the gold, and also with the stock market, if in fact this is the case that we're looking of what we're watching, that's the importance of these numbers, because they're all together. I mean, I haven't seen this come together all in one time where everything is lining up. With yesterday's low being so important, and that's going to be very, very interesting to watch. Now, a long time ago, when we were talking about the the top in the cattle market, I want to go through some of these other commodities, because this is the commodity show, and we need to to talk about what's happened. But the mad cow disease that came out much after the top had formed, we had that big 3-drive pattern butterfly formed up at the 131 level. And it was just a huge ABCD pattern that completed, and now cattle have dropped just about 20% in value, and have they're in the midst of a little bit of a rally in here right now. But that the top of that market has been put in, and so what we'd be looking for now is if we can get an ABCD correction in cattle up to that 121 level, and that would be a pretty good spot where I think it'd be a low risk selling opportunity in the market, folks. I beat the bushes here about the commodities and how important they are, into the context of all of the things that we look at. And one of the things that I watch is the DBA, which is the ETF for commodities. There's others that are pretty good, but I sort of watch the DBA, and believe me, I don't like ETFs. I don't trade them very often. I mean, almost never. And this one looks like it's heading down even farther. We've been down ever since March the 2nd, and we had a little bit of a bounce from that, and it just continued to go down and down. This is true of sugar and cocoa and coffee. All of these are in major downtrends now, and it's really it's getting to the point where people are starting to realize that maybe there's something to a possible deflationary scenario. And believe me, if we get a deflationary scenario, the Federal Reserve is going to be, I think, hard-pressed to figure out where these things are going to end up. We're going to take a little break here. We're going to come back and take a look at the soybeans. 877-927-6648.
What you think about, you bring about. What you focus on grows. If you're committed to becoming an extraordinary trader and investor, then make mastery your outcome. Yes, my best student, Steve Rhodes, became my best teacher. But even more important is what he's taught me, and the time is now for you to take advantage of his knowledge.
Thanks, Tom. I've learned that it's not what we do once in a while that shapes our lives, but what we do consistently. I want to teach you the consistency that exists in the stock, futures, Forex, and commodity markets day in, day out. For one solid day, Friday, May 18th, I'm going to conduct an online master trader course that'll teach you how to buy and sell the D-point. This one pattern alone, with the single best entry and exit techniques, when combined with my money management strategies, will create extraordinary rewards for you and your family. The course will be archived so you can review it as many times as you'd like, and it'll teach you to become a master. All the details are on the homepage at TFNN.com. Sign up today because mastery is one click away. It's your decisions, not your conditions, that determine your destiny.
Wow! Go get them, folks.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks. Ken is a top-down investor who lets price and volume in the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today, click Investment Newsletters, and get Ken Shreve's Ultimate Growth Stocks free for 2 weeks.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Here's what people are saying about Tiger TV.
Let's go to John in Tampa. Hey, John, what's going on?
Hi, Tom. How are you, sir?
I'm doing great. You having a good day out there?
A wonderful day. I love your Tiger TV. I watch it every day. I'm like a kid in a candy store.
Oh, man, I appreciate you out there watching it. How long have you been watching the Tiger TV?
I'm watching almost a month now, and it's wonderful.
It's pretty cool, isn't it?
Oh, yes, it's cool. You see the charts and everything. Thanks so much for the hard work.
Tiger TV, a great news service from TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
To the Futures Hour.
Okay, we're back, folks. We're finishing up the show here with the weekly soybean chart that I posted, I think, about 3 or 4 weeks ago. We were looking at that potential triple top coming in at the 786 on the weekly chart in soybeans, and it is certainly something has happened there because we had one of the larger breaks over the past week or so. In the beans. They're rallying a little bit today because they're oversold, but that top should not be taken out if this is the start of a bear market in the soybeans. So we're watching, for a 61% retracement off this last move that we have, and take a look at it. Now, the largest crop that we have in the United States, that's one of the larger crops in the world, is our corn chart, corn crop. And as you can see from the nearby corn, this is July corn that we're looking at right now, which is the corn that is already been harvested and people are buying and selling it right now. December corn, which is new crop corn that is growing, is much, much weaker. This has been in a very strong downtrending move. In other words, nearby corn is selling for $5.90 a bushel, and the December corn is selling closer to $5 a bushel. So there's a big backwardation in that because the demand for the corn was much stronger, but that demand is dissipating now. And as you can see from the chart that we're looking at here with the corn, is the fact that we've had lower tops and lower bottoms all along. We've been talking about that since March, and we're now coming down to another D move down to this 575 level that we've tested for 7 times, I think, in the past year and a half. So nearby corn at 575 is going to be really interesting to watch if, in fact, it can hold this level. But commodities in general are all heading down. The main ones to watch from a trading perspective and overall the market, I'm going to repeat these again because they're so very important, and that is the silver at 28.60. The other is the gold at 15.80 per ounce. And then we'll be able to see, why it's occurring. Now, someone asked a question, why are cattle and corn going down at the same time? Well, that can happen because they're totally different things. In order to get a pound of beef, I think they have to feed 55 pounds of corn, or 55. Yeah, I think it's 55 pounds of corn to make a pound of meat. If I remember that correctly, Rich Anderson will have an answer to that next time we get him on the show. We'll ask him. But those are totally different. So you got to look at the cattle chart just in totally different, than you do the the corn chart. And also when you're looking at cattle, you have to look at feeder cattle, which are the baby cattle. The ones that are being fed to bring to the table. Those are totally different than the regular cattle also, because each one is a little bit different. That's why hogs are certainly different than the beef. So each one's got to be looked at from a perspective of what the pattern is doing, and that's why I'm a technician, folks. I mean, I got so bogged down in these fundamentals back in the 60s and 70s. I said there's got to be an easier way. And that fortunately I had some mentors that showed me the technical part of the market. And, basically all I'm interested in, if the bar is going up, I know there's more buying. If the bar is going down, I know that there's more selling. And if the bar is closed, I know it's time to go to church. That's all I remember about technical analysis. So we're winding up the show here now. Just remember these prices: $95 in crude oil and $15.80 in the gold per ounce, and then 28.60 in the silver. So keep those in mind, and may everybody have a great day, and may God bless. And don't buy any of the new coins that are coming out, because they have taken "In God We Trust" out, and "In God I Do Trust." Amen.